Welcome viewers to the Surer Gains channel. Today we will discuss how to reduce risks in the stock market. Prudent investors, friends, have been earning very good returns in stock markets all over the world. But many people stay away completely from stocks or invest very little in company shares because of the market risks. They fear losing the principal amount also if the market value of the stocks they own declines. Indeed, the risks in stock markets cannot be made zero, but they can be minimized a lot by following certain measures. And when such measures are in place, an investor can look forward to earning very attractive returns with very little risk. In this video, we are going to discuss 14 such measures which can effectively reduce the risks associated with investment in stocks. This video is made primarily for investors in Indian stock markets. However, the points explained here are generic in nature and can be applicable to stock market investors elsewhere also. So friends, let us start discussing the risk reducing measures one by one. First of all, diversification is extremely useful to reduce risks. Needless to say, one should not put all eggs in one basket. While diversification is useful for reducing risks, over diversification, that is, buying too many stocks, may be counterproductive as it can bring down the overall return on investment significantly. While diversification is useful, one should diversify by buying good quality stocks only. In case of equity mutual fund schemes also, one should diversify by investing in highly rated schemes only. Apart from diversification, we can reduce risks by investing in systematic investment plans, that is SIPs of good equity based mutual fund schemes, instead of making one-time lump sum investments. If this is done, risk of buying units when market is high will be eliminated significantly. Moreover, these SIPs enable investors to build wealth in a disciplined manner over a period of time. Another way to build wealth is to make long-term investment in broad-based index funds, that is, in index funds which invest in frontline indices. If the investment is a long-term investment through SIPs, risk of losing money becomes very small, in fact minuscule. This is because SIP reduces risk as already explained. Further, long-term investment also reduces risks in stock market. Last and perhaps the most important reason of practically nil risk is due to the fact that in a frontline index, the performance of the constituent companies is examined periodically by exchanges with reference to a well-defined criteria. Poorly performing companies are brought out of the index and well-performing companies are brought in. In other words, composition of indices is rebalanced periodically in a logical manner so as to include best performing companies in the index. Therefore, For a long-term investor who invests in such index funds, there is hardly any risk. Friends, another way to reduce risk is to have a capacity to hold the investment for a long period. This will help in avoiding panic or distress selling at a loss. This can only be done if the investor invests the money which can remain invested for a long time. In other words, this should be the money which can be spared for a long time. Next way to reduce risks is to make some investment in gold or in gold funds, which reduce the risk on an overall basis. This is because price of gold usually increases, though not always, whenever there is an economic recession or in times of war and in times of high geopolitical tensions. Nevertheless, it should be appreciated that the long-term annualized returns on investment in gold are not very high. Therefore, investment in gold should not exceed 5 to 10% of the overall portfolio value of the investor. Friends, care should also be taken to ensure that the entire portfolio is not in equities only. Prudent allocation should be made to the other classes of assets also, namely in debt, gold and real estate, etc. One can also invest in multi-asset schemes of mutual funds. However, it should be realized that in the long run, equities tend to outperform all other asset classes in terms of annualized returns over a long period of time. And therefore, equities should always constitute a significant percentage of the overall portfolio. Friends, another measure that can be taken to reduce the risk is to consider investment in good dividend yields stocks, which also lowers the risk. But dividend yield should not be viewed in isolation. Potential for appreciation in share price in future must also be looked at when good dividend yield stocks are examined or shortlisted for investment. Investment in dividend yield mutual funds can also be considered. Another measure, friends, investment in PSUs or state-owned stocks should be decided very carefully. Reason for this is that state-owned companies have to look at social objectives also while performing operations. In other words, they are guided by non-commercial objectives also many times. This reduces returns for investors. Friends, investments should preferably be made for long term only. And before making long term investment in any share, long term price chart should also be looked at. This will help in avoiding undesirable investments by clearly giving an idea of the long-term price performance of the share. Next, it should also be realized that long-term investing is safer than short-term trading. Risks are associated more with short-term or day trading than with long-term investment. Moreover, buying shares at declines, that is at a lower price, also increases the margin of safety and reduces risk. Whether it is equity mutual fund or share, Choose the right stock or right mutual fund carefully and hold it for long period. Short-term minor fluctuations in share price or in the net asset value, that is NAV of the mutual fund, should be ignored. But stop loss limit must be set when buying a stock so that if the share price falls beyond a point, share is sold so as to limit losses. Last but perhaps the most important point is to look at the PE ratio of a share. If P by E ratio is say more than 60, do not invest in it, or at least be very cautious at the time of making the investment, howsoever good the track record of the stock may be. Growth stocks do command a higher PE multiple, but beyond a point, there is always a risk. Let me add a disclaimer here in the end. Viewers are requested to obtain independent professional advice besides doing their own homework before making an investment decision. Objective of this video is to merely provide an additional relevant information or input to the viewer. Moreover, here any specific stock has not been discussed. In the end, thanks for watching this video.